All right, so just a couple more minutes. It's 1:58. We'll give everybody a couple more minutes and then we'll get started. 1:59 now. Hi there. Okay, well, it is 2 o'clock. I am recording this, so for anybody that wasn't able to join us today, I will have the recording and I'll email everybody out the link to the class recording if you wanted to refer back to it again, or for anybody that's not able to join us. So I had this really fun exercise picked out for us in class. Maybe we would have thought it's fun, maybe not. Where we could get a little practice with the tax research and going through the internal revenue code. And I know we've already looked at it together a little bit already. And so I was going to let everybody get into groups, divide everybody up into groups. And then I had some specific research problems picked out, but that's okay. We're improvising, right? So what I want to do is I'm going to write or type in rather some information from the remainder of chapter 2. So the remainder of chapter 2 that we haven't gone over with or gone over together yet is the tax research portion of it. And so I want us to take some notes because we do have a question on the first exam from that information. So I want to make sure to point that out. And then again, I've got a few tax research problems for us picked out for us to work through together. And then I will send this document out once we're done. We're all finished up for the day. I will send this document out so everybody has a copy of it as well. So let me share my screen with you and I will get this pulled up. So here's the document. I want to, and it's just a Word document. Like I said, I will send this out to everybody once we get finished up today, along with the link for the recording of this for anybody not able to join us. But tax research. So the second part or the last half of chapter 2 is about tax research. And this starts on page 17. So I'll just put starts page 17. And it starts off by talking about the tax research process and kind of those steps involved in the process of tax research. So step 1, identify the problem. Okay. Step 2, locate and assess appropriateness of tax law source. And we'll talk about that appropriateness a little bit more once we talk about some of the different sources, primary versus secondary. Step 3, arrive at and communicate solution to taxpayer. And then lastly, step 4, and this is on an as needed basis, update the solution if new info becomes available. So if new information becomes available, we might need to update the solution or change the solution. But those are kind of that basic, those basic steps in the tax research process. And again, we're going to get a little bit of practice with that together today. The reason why I wanted to make sure to point these steps out to us is because we have a question on the first exam on this process. So as long as we know these steps, then we'll be okay, right? But we've got an exam question or test question here. So we need to know these steps of the tax research process. All right. Next, our textbook goes into the different tax sources. And so we've talked about these together before, but this part of the chapter again is just giving us an overview of the sources and then also aggregating them into primary versus secondary sources. So some of our sources include legislative, and again, we've talked about this already. So legislative sources, and I'm going to put on here the Internal Revenue Code. And again, we're going to look at this more together. But that is the primary legislative source, that Internal Revenue Code. And in our book, and this is on page 20 of our textbook, with that Internal Revenue Code, it says that the code should be the first source to be consulted by the tax researcher and often is the only source needed. So the first source that should be consulted, usually the only source needed. Okay, again, and we're going to get some practice, more practice looking at that Internal Revenue Code again together today. So administrative sources. Administrative sources. Okay, so these, again, we talked about these before. These relate to the Treasury regulations and the IRS pronouncements. So again, thinking about those Treasury regulations, the final or legislative regulations, and then those IRS pronouncements, things like the revenue rulings, the revenue procedures, the letter rulings, the determination letters, right? Some of those IRS pronouncements that we've talked about already. Okay, judicial sources. Judicial sources. And so these are court cases. What's nice about this book too, as we go through and we learn more, like, for example, in our next chapter, we start talking about gross income. And as we're going through the book and learning about some of the different gross income items, they'll refer to either court cases, how something was handled, or refer to the section and subsection of the Internal Revenue Code. So it continually gives us kind of footnotes or the sources that those examples relate to. So that is a nice thing about our book. And then finally, some of the unofficial sources. And these are some of the publication journals that they talk about. They list some of the different publications on page 20, for example. And so some of those, again, unofficial sources, not updates to the law or regulations or pronouncements, but again, some of those unofficial sources, blogs, tax publications, legal opinions, things like that. So those are our main sources. And then again, primary versus secondary. So the way these are divided up, our primary sources, as you can imagine, relate to the, as we talked about, the legislative, the administrative, the judicial, right? Our primary sources. So primary source number one is the Constitution. And specifically, it's the 16th Amendment that relates to taxes. Amendment, what did I do wrong here? The 16th Amendment that relates to taxes. The legislative sources. That we discussed up above, statutes, treasury regulations. Again, we talked about those above. Another primary source, IRS pronouncements. And then judicial decisions. Again, we've talked about each one of these before. We touched on them up above as well. And all of these primary sources together represent substantial authority. Substantial authority. Okay, and then our secondary sources, which again, I mentioned a few of them already. Secondary sources. Some of these include the tax publications. And I'll put in the notes here on page 20 of our textbook. It lists some of these different publications. So the Journal of Taxation, the Journal of International Taxation, Practical Tax Strategies, Estate Planning, Corporate Taxation, Taxation of Exempts, Real Estate Taxation, Journal of Multi-State Taxation and Incentives. So several of these, again, tax publications that do not represent actual tax authority. So tax publications, legal opinions, written determinations. And these do not constitute tax authority. So again, that's kind of a summary of the second half or the last part of chapter 2, and some of those main points that they make in chapter 2, the notes that I would have written on the board for you to take. So any questions about what we've talked about so far? Is that looking okay? All right. And again, I know I said this already, but once we're finished up together today, I will send this document to everybody so you have it for your notes. So then let's look at the second half of this. And this is what, if we were in class, we were going to get together in groups and we were going to work on some of these. And so I have 5 different exercises or tax research problems picked out for us to do. And for each one of them, we're going to consult the Internal Revenue Code. And what I did is I took a picture on my phone of these, so I didn't have to keep flipping back and forth screens on you, because once I start sharing the Internal Revenue Code website, then it's not going to show you the Word document any longer. But again, I will email everybody a copy of this. I just took a picture with my phone, so I don't have to keep flipping back and forth. So anyway, this first one, it says, During the year, a client purchased a gift for a spouse who became a citizen of the US in the year subsequent to the gift. So in the year after the gift, right? The gift was land on which the client intends to build a house. The client knows that there is some form of gift tax deduction allowed for the gifts, but has further questions concerning how the gifts affects the clients and the client's spouse. Which section and subsection of the code defines the applicability of the marital deduction for gift tax in this situation? So for this one, again, I'm going to stop sharing the screen now, and I'm going to get the IRS website pulled up. Hi there, everybody, or the Internal Revenue Code, rather, pulled up so we can take a look at it together. So again, we looked at this in class together. We've already kind of clicked around a little bit and got some practice with it. But this relates to the gift tax, right? That's what the information we just read. During the year, the client purchased a gift for a spouse who became a U.S. citizen the next year, the year subsequent to the gift. The gift was land. I mean, either way, we're here, right? We're in subtitle B, estate and gift taxes, okay? And this is specifically a gift tax. So we're looking at chapter 12. And so chapter 12 is divided up into subchapter A, determination of the tax liability. Subchapter B, transfers. Subchapter C, deductions. Well, this relates to the deduction, right? Because it says the client knows that there is some form of gift tax deduction allowed for the gifts, but has further questions concerning how the gift affects the client and the client's spouse. So this is what we're looking at, deductions. And then we can see deductions is divided up into charitable and similar gifts, gifts to spouse, extent of deductions. Again, we're looking at a gift to the spouse, right? All right, so now we can get a little bit more in depth into this. So allowance of the deduction, where a donor transfers during the calendar year by gift and interest in property to a donee who at the time of the gift is the donor's spouse, there shall be allowed as a deduction in computing taxable gifts for the calendar year an amount with respect to such interest equal to its value. Well, we've already got a problem in that the gift was made when they were not married yet, right? Remember, it says during the year, a client purchased a gift for a spouse who became a citizen of the U.S. in the year subsequent to the gift. So excuse me, the spouse became a U.S. citizen, right? And so let's see here. So that's life estate or other terminable interest, interest in unidentified assets, joint interest, life estate with power of appointment, election with respect to life estate for donee spouse. In general, okay, it's not a life estate, so we're not dealing with that. Treatment of joint and survivor, again, it's not for an estate, so we're not dealing with that. This is where it's referring us to. So disallowance of marital deduction where the spouse is not a citizen. So on this particular problem, excuse me, it's asking us to refer to the section and subsection of the code. And so this is our subsection. So if the spouse of the donee is not a citizen of the United States, no deduction shall be allowed under this section. So this is what is applicable to our problem. So again, if we were entering in our answer here, if we go back up, so it's letter I, So this is section 2523, subsection I. I'm going to go ahead and type this into our Word document really quick. So we have the answer in our Word document. So 2523. So this is section 2523, subsection I. Okay. I typed that into the Word document. So when I send you the copy, you will have that as well. Okay, let's look at the next one. So the next one, it says, 5 years ago, as the result of an examination of your client, the IRS assessed a $5,000 tax liability, which remains unpaid. Which section and subsection of the code defines the length of period after assessment during which the IRS has to begin court proceedings and then to collect the taxes? So let's go back and look at this one. We're going to start back at the beginning. So again, if we look at our subtitles, we've got income taxes, estate and gift taxes, which is where we were just a minute ago. Employment taxes, we're going to go into that one more when we start looking at businesses, right, next semester. Miscellaneous excise taxes, alcohol, tobacco, and certain other excise taxes. Procedure and administration. Okay, so this deals with a court case, right? It says, which section and subsection of the code defines the length of period after assessment during which the IRS has to begin court proceedings? So this deals with procedure and administration. So if we click on procedure and administration, we can see the different chapters here. And we are looking for court proceedings, anything relating to court proceedings or collection of taxes. And so for this one, we've got what? Information and returns, time and place for paying tax, assessment, collection, abatements, credits, refunds, limitations, interest. We're looking at limitations, maybe. Let's see, 6. Okay, limitations on assessment and collections. I think that's where we're at, assessment and collections. Limitation on assessment and collection after assessment. All right, so length of period, where the assessment of any tax imposed by this title has been made within the period of limitation properly applicable thereto. Such tax may be collected by levy or by a proceeding in the court, but only if the levy is made or the proceeding began. So here's actually our answer: within 10 years after the assessment. So the IRS can bring a suit to collect the taxes in court within 10 years of the assessment. In this particular question, it was 5 years ago the assessment was made, so the IRS still has essentially 5 years to bring a court case or bring the suit in court. So our answer would be section 6502, subsection A, right? 6502, subsection A. So I'm going to go ahead again, type this into our document so we have the answer. Section 6502, subsection A. Okay, the next one that we have, let me highlight this and bold it for us. Let's see, the next one that we have, or the next tax research problem that we had, it says, what code section and subsection indicates the number of days between purchase and sale for determining the loss limitation on wash sales. So this relates, we're going to talk about this more in chapter 7 or chapter 8, if I'm remembering correctly, but this relates to when we're selling or purchasing an investment. So the number of days between purchase and sale for determining a loss limitation on wash sales. Okay, so let's look at this one. So we'll go back to the beginning. This relates to, let's see, which code section, subsection indicates the number of days between purchase and sale for determining the loss limitation. So this would have to do with a loss deductible on our income taxes. So we're going to be in subtitle A. And then normal taxes and surtaxes, tax on self-employment, that's not it. Unearned income on Medicare contribution, that's not it. Withholding of tax on non-resident aliens and foreign corporations, that's not it. Taxes to enforce reporting on certain foreign accounts, that's not it. Consolidate. So we've got to be in chapter 1, normal taxes and surtaxes. And again, we're looking at loss limitations. This relates to investments or capital assets. And so for this one, let's see, determination of liability, taxable income, corporate distributions, deferred compensation, accounting periods, exempt organizations, natural resources, banking institutions, that's not where we're at. Partners and partnerships, insurance companies, regulated investment companies, tax based on income from sources within or without the United States, that's not us. Gain or loss on disposition of property. So that's where we're at, because again, this relates to selling an investment and either the gain or loss in this case, because they're asking about loss limitations. So this is where we're at. Okay, so determination of amount of and recognition of gain or loss, basis rules of general application, common non-taxable exchanges, special rules. Here we see wash sales, and that's what it's asking us. The number of days between purchase and sale for determining the loss limitation on a wash sale. All right, so we're on wash sales, losses from wash sales. Okay, so here we go. And this one, disallowance of loss deduction. So it says, in the case of any loss claim to have been sustained from any sale or other disposition of shares of stock or securities where it appears that within a period beginning 30 days before the date of such sale or disposition and ending 30 days after such date, the taxpayer has acquired by purchase or by an exchange on which the entire amount of gain or loss was recognized by law, or has entered into a contract or option so to acquire substantially identical stock or securities, then no deduction shall be allowed under section 165 unless the taxpayer is the dealer in stock or securities and the loss is sustained in a transaction made in the ordinary course of such business. So in other words, 30 days, right? That's our number of days between the purchase and sale, if we want to claim a loss limitation. Otherwise, if it's within 30 days, like it says, then no deduction shall be allowed. All right, so again, on this one, our answer would be section 1091, subsection A. Let me type that into our document. Section 1091, subsection A. All right. Two more of these. This next one, it says, an individual taxpayer is selling her principal residence, so where she lives, in other words, her principal residence, which she has owned for 10 years and lived in for 9 years. What section and subsection of the Internal Revenue Code states the amount of gain that a taxpayer can exclude from gross income from the sale of her principal residence? Okay, so let's go to our code. We want to go back to the beginning. All right, and this relates to the amount that the taxpayer can exclude from gross income. Okay, so exclusions, again, we're going to be dealing in subtitle A in income tax, right? And then normal taxes and surtaxes. Again, if we click on here, we see our different subchapters, and we're going to be looking at taxable income, how much is excluded from taxable income in this case. And so once we click on that taxable income, again, it gives us some different options here. Definition of gross income. This is where we are going in our next chapter, right? We're getting into gross income items. So we're going to spend a lot of time on this in our next chapter. Items specifically included, items specifically excluded. That's what we want, right? Because it was asking us for the amount the taxpayer can exclude from gross income. So items specifically excluded from gross income. Okay. Now we go here and it's got, okay, death benefits, gifts and inheritances, interest on state and local bonds, compensation for injuries or sickness, amounts received under accident health plans. So we've got several options here. We're looking for real estate assets, right? This is her principal residence. So let me scroll. So what do we got? Income from discharge of indebtedness, income from states, qualified scholarships, contributions to capital of a corporation, meals and lodging. Okay, here we go. Exclusion of gain from sale of principal residence. All right, so we click on here and it wants to know the amount of gain that a taxpayer can exclude. So here's our information on limitations. The amount of gain excluded from gross income under subsection A with respect to any sale or exchange shall not exceed 250,000. So there's our answer, the amount that would be excluded, the amount of gain that would be excluded. So in this case, our answer would be what? Section 121, subsection B. There's our section 121, subsection B. I'm going to go ahead and type this in for us. Section 121, subsection B. So if we're feeling froggy later and we want to go back and look at these rules, we can, right? Okay. All right. Anyway, one more of these. This last one, it says Arrington Enterprises incurred $15,000 of startup expenses. What code section and subsection provides guidance for making an election to deduct any of the $15,000 incurred and amortize the balance equally over 180 months? So this one, we're actually, I know this comes up again in our later chapters that relate to business entities, right? So when we get into business entity, taxation of business entities next semester, But nonetheless, we can look at it. So let's pull back up. We want to start from the beginning. Okay, so here's our main section. This one is asking us about startup expenses and what portion is a deduction, if any. So this is going to be in our income taxes. And when we're looking at this, self-employment, that's not mentioned in it. Unearned income, withholding tax of non-residents. Again, we're in chapter 1. A lot of ours are in chapter 1, right? A lot of our tax research questions that they refer us to. And in this case, we're looking at how much is deductible. So same thing with the gain from the sale of our principal residence. We're looking at how much can be excluded from taxable income. So that computation of taxable income. And then we're looking at, okay, what do we got? Definition of gross incomes, items specifically included, items specifically excluded, tax exemption requirement for state and local bonds, deductions for personal exemptions, itemized deductions for individuals and corporations. So that's where we're wanting to look at. It says Arrington Enterprises, Inc., which means incorporated, which means a corporation, right? So this is where we're looking at. And then if we click on here, it gives us all these different types of deductions allowed, again, for individuals, some deductions allowed for individuals, some deductions allowed for corporations. In this case, we're looking for startup expenses, right? So if we just kind of scroll down here, and a lot of these we go more into, again, when we get into taxation of business entities, and I'm just kind of scrolling real quick, scanning these and looking for those startup expenses. And there we go. Section 195, startup expenditures. All right. And then it's asking us again for, they had 15,000 in startup expenses. How much can be deducted and then what would need to be amortized. So if we're looking here, election to deduct, and here we go. Here's where it gives us our answer. So it says, if the taxpayer elects the application of this subsection with respects to any startup expenditures, the taxpayer shall be allowed a deduction for the taxable year in which the active trade or business begins in an amount equal to the lesser of, okay, so we want the lesser of the amount of the startup expenditure with respect to the active trade or business, or 5,000 reduced but not below zero by the amount by which such startup expenditures would exceed 50,000. So again, we get more into this and we actually get practice with this calculation when we get to business taxation. But essentially what it's saying to us is that 5,000 can be deducted the first year. And then right here, letter B, the remainder of the startup expenditures, which in our case, because we've got a total of 15, the remainder, the 10,000, would be amortized over a 180-month period, beginning with the month in which the active trade or business begins. So again, 5,000 deductible immediately, the other 10,000 deductible or amortized over a 180-month period. So our answer would be section 195, subsection B would be our answer. Section 195, subsection B. Okay. Anyway, that just gives us a little bit more experience looking through this Internal Revenue Code. as we continue on through the textbook, we will refer to it more. And then especially again, when we get to taxation for business entities, real quick, if we go back here and we say, okay, income taxes, normal, we can see here, all right, so for example, which I passed it up, subchapter C relates to corporate distributions and adjustments. So when we get into corporations, I think chapter 14, chapter 15, we talk about corporations. Will refer to these sections more. And then if we look here, subchapter K, again, partners and partnerships, we've got a chapter in the latter part of our textbook that goes over partners and partnerships. So we'll refer to those sections more. And then subchapter S, looking down here at subchapter S, tax treatment of S corps and their shareholders. So again, we've got a chapter about S corps, and so we'll refer to this Internal Revenue Code more. But anyway, while I've got this pulled up, any questions about the Internal Revenue Code or what we talked about together today? All right. I know we're super pumped to get more practice with it, and when we go through our chapters, right? Hi there again, everybody. Okay, guys. Well, like I said, I will send you this Word document so you have these notes and the answers I took down today. And then when we come back together next week, we're starting chapter 4, okay? We skip over chapter 3 because if you've looked at your book, chapter 3 relates to financial statements for the business, taxes in the financial statement. So we will cover chapter 3 next semester. We'll cover chapter 3 when we look at taxation for business entities. But again, this semester we focus on taxation for individuals. So we'll skip over to chapter 4. Chapter 4, we're going to cover next week and the following week. So we'll have, several course or class meetings to cover chapter 4. But that's what we will pick up when we come back together next week. So any questions for me at all? We're excited to get the holiday weekend started. Yeah. All right, guys. Well, you know where to find me if you need me. Otherwise, I'll see you next week, and everybody have a good holiday. Okay.
Have a nice weekend.
Thank you.
Bye. You guys too. Bye-bye.
Thank you.